Hey, hi. Today I just wanted to share with you a couple of news that has been happening the last 1 week, and how May ended and how we are looking at June. Of course, there's been a couple of very interesting news by some big heavyweights like Tesla CEO, having a super bad feeling about the U.S. economy, and then you get Jamie Dimon, who is very famous, who is of course JP Morgan's chairperson or CEO, and he said that the economic hurricane due to the Fed rate increases and Ukraine war uh, may instead of just uh, calm before the storm, and there could be many reasons that I think he says this, which I think I'll cover that in another video. I think part of the reasons I'll just summarize them here is could be um, the, the consumer savings has been at its lowest, based on the most recent data. It has been the lowest since 2008. It went up to a pretty decent level during the COVID period, and then after that, with all the stimulus, people are spending again, and then recession, that the real effect of the recession to the economy may happen after 8 to 9 months if people don't go back to the job markets to look for jobs. Um, so, and of course, another thing is the Fed, as we mentioned before, unable to control the supply side of things. That has to be the government. I.e., for example, open up the oil reserves, speaking to the OPEC plus, or find ways to end the war via negotiations so that all the wheat exports to people that are in urgent needs like Egypt and all that as well, especially who import 80% of their wheat from Ukraine and Russia. And then of course the Fed will takes care on the consumer demand side by slowly increasing the interest rates. Um, of course, the purpose of this video is to talk about this new thing called the economic tightening, monetary tightening that starts in June, which I think is actually a new issue. I know in the last couple of months we've been talking about what do you call it? Uh, Inflation threats that will affect the market. But now, actually, we are looking at these inflation issues as well. I just want to touch on this quickly on what this actually means to you and me.
Now, if you're confused, let me explain. We were promised by the central bank that on June 1st, we would start this process of removing money out of the system. But the question is, how do we exactly remove money out of the system? So here's how it works. It's the opposite process of quantitative easing. This is when we would make fun of Papa Powell printing too much money, right? But that's not exactly what was going on. Instead, what the central bank was doing was buying $120 billion worth of assets per month. $80 billion of that money was going towards Treasury bonds, and the rest of the $40 billion was going into mortgage-backed securities. Now, they did this for so long that they ballooned their Federal Reserve balance sheet to roughly $9 trillion because they bought $4.6 trillion worth of these assets. So the obvious question is, why does the Fed have to do that? Why can't they just flip a switch, change some numbers on a computer screen, and just make everything perfect again? And the answer is because they can't. So here's what they do instead. When the central bank buys those assets, it modulates their prices and therefore their interest rates. So when you go to buy any assets, right, you slightly increase their value, but in turn, you decrease their yield or their interest rates. And that's what the Fed did to stimulate the economic growth, because that's what we had to do. And that's why we saw mortgage rates drop to crazy low levels. But now that we want to slow inflation down, we have to reverse the engine and start selling the assets, because once you start selling, like anything else, you drop the price, but then you also increase the interest rates, and that's how you drain the liquidity. Now, I know that's super confusing to understand, so imagine it like this. So imagine you were a kid again, and let's say you were were the main friend in your friend group, which, if you remember what it was like being a kid, usually meant that you were probably the oldest, or in this case, let's say you're L and you have superpowers. That would do it too. But the point is that all your friends have way too much money, and they've been lending their money to all their other friends as well, and that's really contributed to inflation and the rising cost of pop rocks. Remember those? So then the question becomes, how do you incentivize your friends to give you back the money?
Yeah, so basically what it means, this monetary tightening, what the Fed will be doing is actually to purchase around like 110 billion a month of treasury of bonds, buying back. So which is actually going to reduce liquidity in the market, which in turn actually means that the Fed, the commercial banks that are linked to the Fed, which is the Fed's friend, for example, will have less money to lend out to people. So of course, capital spending will be affected by this monetary tightening, and as you can see, when this shrinking or monetary tightening on buying back of all these bonds, right, which and cancel them off, it will actually increases the yield of the bond. Of course, bond becomes more valuable. So I just want to show you a couple of another short clips before I sign off, talking about this the importance of bonds being the next fear, which I think many institutional investors will jump into treasury bonds, and whereby the yield will be more than 3%. Now, of course, yield it has hiked up recently to 2.95. As you can see the charts here, it was trending downwards. Went by below 1%, and it was actually very good for the equities market. But if this is high, it means that equities market uh, will not be attractive because people will feel safer to actually go in here and buy treasury bonds and get a very safe 3% instead of having to bet on stocks, and you might even lose money. Of course, treasury bond is a lot way better. This is a treasury yield 10 years. You got 5 years, you got 20, you got 30 as well. So I'm going to show you quickly on these clips as well.
We're going to start selling $47.5 billion worth of assets every single month. 30 billion of that will be sold of treasury bonds, and 17.5 billion will be those mortgage-backed securities. Then after 3 months of selling, it's going to double to $95 billion a month, with $60 billion will be those treasury bonds, and 35 billion will be those MBSs, those mortgage-backed securities. The Fed will continue selling the assets until it feels it is consistent with ample reserves. But that's the first problem, because we don't know what ample reserves exactly means, so I tried to find out. Citigroup, for example, believes that it's $2.5 trillion, and Barclays believes it's closer to $2 trillion. So maybe it's somewhere in the middle. But there are a few guesses about what's going to happen to the federal fund rate as a result of all this selling, and here's what it is. The range is anywhere between 0.25% and 1.25% of an increase to the federal fund rate. That's a huge variation. Here's the easiest way to think about the market psychology right now, because if the market shows you a simple equation like 2 plus 2, everyone would say 4. No one would disagree. But if you were to be shown this equation, then you'd have all sorts of crazy answers like -10, 100, infinity. That's why there's so many different opinions out there, which is why some people are selling all of their investments, some people are buying more bonds, some people are selling crypto because the crypto winter is coming, other people are...
Yeah, so of course, that's of course the YouTuber actually went on to ask himself, the viewers, what are the asset class that you can actually go into, as crypto is also entering crypto winter as well. So well, as you can, I hope you get a good idea about what is the start of June going to be like, with this new, so to say, threats to the equities market, and I'll keep you up to date again on that more interesting news and all that. So thank you for watching the video, and please like and subscribe.